All right, guys, let's move into our last segment here that we play on Thursdays, and that's going to be our buy one, hold one, dump one. And Greg, I've really enjoyed this, quite frankly, because we do so much trading analysis, option analysis. We always do big picture economic analysis. We don't always do fundamental analysis every day, and which is why bringing you in here to kind of highlight a segment where you break down three different companies from a fundamental perspective. You find three that you like, you kind of present them, and then we get to decide which one we're going to buy, which one we're going to hold, and which one we're going to dump in a little game that we play here. Greg, what you got for us today?
Well, I was looking through the sectors and I came across XHE, which is healthcare equipment ETF here. Notice that we're working our way higher, getting back there to a possible breakout scenario there. So showing some strength. XLV's obviously done okay as well. But I just looked at this one and I thought, okay, let's see if we can delve into this and find some candidates that maybe got some, just a combination of fundamental strength and maybe some growth prospects as well. I've been trying to kind of mix in the two with the picks here. So this is a sector I chose to dive into today, and I got three picks here. We're gonna start with the big dog, ABT Abbott Laboratories. So this one here, you're going to see that these are a little different than the ones I've been bringing recently. I wanted to kind of switch it up and give you guys a little more to think about here. So basically, chart-wise, this is a little different than what we've been looking at. Typically, we've been looking at things kind of at the higher end range and things like that. Well, as you can see, we've had a pretty significant gap down here, kind of starting to retrace back up here, running into some of these moving averages here. So the question that you need to ask yourself is, from the technical perspective, is can we move past these barriers? And I'll go through the fundamentals in a second here. So anyway, like I said, Abbott Laboratories, probably a name a lot of folks know. The next two that I'm going to give you guys are going to be less well known. LMAT is one of them. So this one here, more like what I've been showing you guys for the last few weeks here, pushing its highs, pretty significant run here. Lower dollar stock here, but half the price of ABT. I'll go through the fundamentals again in a second here. So again, just a little different look technically, but showing some strength here. And then finally, we have X-Ray. So X-Ray, again, little different look here. They've all had a little bit different looks here. So pull back here, trying to find some support, flirting with those moving averages. Overall, nice bullish trend over the last, I guess you got a year chart up here. Little retracement here after hitting a high, looking for some support there on this one. So just three companies that are all basically in the healthcare equipment space. I kind of threw that equipment part in there. They have some exposure to that. So I'll run through some numbers here. I will start with Abbott Laboratory, about $112 stock in that neighborhood there. Their dividend yield is 1.64%. They've got 7 years of consecutive dividend increases. They started paying dividends in 1926. Their payout ratio is 51. Now, I'm going to give you the PE for these. There's a couple of PEs here that I don't know are accurate. The place I get them is not always the most accurate. So take that with a Jerome Powell grain of salt. So payout ratio 51%. The PE ratio for Abbott Laboratories is about 35. Okay, we got some sales growth number here. Now, this one's interesting. The sales growth this year is about 13.7% currently. Their sales growth next year is actually negative 0.8. So they're expecting falling sales growth next year. Assets versus liabilities. This is more your fundamental data here. They're sitting on about 72.5 billion in assets versus 32.5 billion in liabilities. So showing a bit of strength there. They've got 7.6 billion in free cash flow, and they've had 4 years of consecutive net income increases. So every year for the last 4 years, their net income has gone up. Okay. So that's Abbott. So next up, we got LMAT. So $60 stock. So again, about half the price of ABT. Their dividend yield is 0.75%. So not crushing the ball, the cover off the ball there, but 9 years of consecutive dividend increases. They started their dividend payments in 2011. Their PE ratio is 35. Or sorry, I apologize. That's payout ratio is 35%. Their PE that I have is 50. Their current sales growth is 17.6%. And next year they're expecting 6.6%. Okay, so smaller cap company here. They're about 252 million in assets and about 80 million in liabilities. They're sitting on about 36 million in free cash flow, and they got 2 years of consecutive increasing net income.
Okay.
All right, and finally, our friends at X-Ray there, about $65 stock in that neighborhood. Their dividend yield is 0.67%. They've been paying dividends, increasing for 9 years now. They started paying dividends in '94. Their payout ratio is the same as Abbott Laboratory, is at 51%. Now their PE ratio, and this is the one that I think might be a little out of whack. Their PE ratio I found was 83. So that one, again, like I said, the data I get is not always the best. So current sales growth, 27.1% sales growth this year, and expected 5.2% next year. Assets versus liabilities, they're looking at about 9.3 billion in assets versus 4.3 in liabilities. They're sitting on 600 million in free cash flow, and they have 0 years of consecutive increasing net income.
All right, so let's go through these three and kind of talk about them a little bit, because this is an interesting one here, Greg. You know, sometimes you bring companies that are very, very similar, obviously in pattern and also trend, as well as some of the fundamentals. This one, we've got a little bit more of a puzzle to unpack here, Tyler. I think Greg is trying to make it a degree of difficulty a little bit higher here for us, having some fun with that. So let's talk about these three companies. And Tyler, if you could bring up the data a little bit while we talk about them as well, or unless you want to look at the chart and then bring up the data. Either way, X-Ray, it's a $14 billion medical instrument and supply company, right? Like you talked about, Greg, you know, they've got some interesting chart patterns in that regard. Dividends started in 1994. Tyler, what other detail do we have on X-Ray there? That just go ahead and read that out for me.
Yeah, so X-Ray, I'm sorry, did you cover the first couple yet?
No, we haven't covered the first two. Just
all right,
X-Ray.
so $65 stock, dividend yield 0.67. So the lowest dividend yield of the three. Increased 9 consecutive years. Is it years, right, Greg?
Mm-hmm.
Yeah.
Started paying in 1994. Pays out half of its earnings in dividends. PE ratio, if it's correct, is pretty high at 83. But got a high growth rate to help back that up. So 27% this year, 5% next year. Pretty big discrepancy.
Mm-hmm.
Assets 9.3 billion versus 4.3 billion in liabilities, sitting on 600 million bucks, and has not increased income multiple years. Which Greg, I assume part of that's the whole 2020 COVID crap, Jack, and that freak up, right?
Yeah, that one there. When I looked at the data, they basically go. Net income increases 1 year, and then it falls off the next year, and then it increases the next year and falls off. So when we look at consecutive years of increasing the net income, that one fell short.
Can that be a function of just being a smaller company, not as mature, not as able to?
It very well could be. It very well could be. Like you'll notice here, like Abbott Laboratories is obviously the one that everybody would be familiar with. And, you know, their numbers are very different. What I was trying to get here was just to get three kind of in the same space. Some more established, obviously Abbott Laboratory, some a little bit newer, as you can see here, like LMAT's pretty new, you know, from a dividend perspective and things like that. So just kind of trying to mix it up a little bit there. Yeah, that particular company, they make money, right? They've done okay in that respect, but it doesn't seem that they are as consistent as what the other two have been here.
Mm-hmm.
Right.
Now, with this one here on X-Ray, what's interesting, because I don't know this company that well. I haven't traded it. I can't remember a single time I have, quite frankly, but I have seen it before. So I knew about this company. It's obviously a $14 billion large cap medical device company. Do you know what they sell? They sell dental equipment, dental products, dental machinery, dental surgery equipment, stuff like that. You know who didn't go to the dentist last year? A lot of people who couldn't go to the dentist last year. So they're they're big. In fact, they had a revenue drop of about 25-30% over the course of 2020. And that does make sense with the pandemic and restrictions and all that kind of stuff. Their PE ratio at 82, it's a startling big number, Greg, but that, to me, there's context there. Their forward PE ratio based on earnings the next 12 months is only 20, and their historical PE ratios are nowhere near the 80 level. This is not a growth company. This is a value company that pays a dividend. Just had the price of the product, price of the company is still very elevated while earnings decreased over the last year. So it doesn't mean I'm going to buy it. I've just wanted to give you some context there because I just dug into some of these numbers. Yeah.
Makes
Dental
sense.
supply company. All right. What about the second one?
Now,
All right,
sorry, Ty, give me one second. So I want to say that, the numbers, the revenue numbers that have dropped for them last year because of the pandemic, if you look back I guess it's 3-4 years ago, they also had a drop there. And that's kind of where they can't use that pandemic as the excuse back in 2016 or whatever it was.
Mm-hmm.
So they kind of have an upswing in net revenue and then a drop. And now the other part of that is that could be based on the business that they have, right? They sell equipment for dentists and things like that. Maybe their customers are not buying every year. Maybe they're buying it on a certain yearly basis or bi-yearly basis, something like that. So that could, again, obviously their numbers could have fallen because of pandemic last year, but it also could be a cyclical type business in that respect as well. So
gotcha.
Just to throw that point in there.
Gotcha. What about LMAT and Abbott? Ty, give us just a quick run through of the numbers that Greg gave us so we can start to make a decision here. I've got a little puzzle on my hands here, Greg. I'm still thinking through this one. So go ahead, Ty.
Yeah, LMAT $60, 0.75 dividend yield. So, as far as LMAT and X-ray, those are two pretty comparable. Dividend increase number of years is also the same. LMAT started paying in 2011, pays out a little less of its earnings in the form of dividend, 35%. PE ratio at 50. I'd be interested to see if there's context around that one too, Tim. Sales growth pretty high, 17.6% this year, 6.6% the next year. $252 million in assets versus $80 million in liabilities, $36 million in free cash flow, and 2 years of net income increasing consecutively.
Mm-hmm. Yeah, they sell a lot of medical devices, surgery type stuff for blood vessel surgeries, embolectomies, it looks like catheters, stuff like that. So medical device company is going to be sensitive to how many people do surgeries. Forward PE ratio is still 42 ties. So this is a growth company. It's $1 billion. Instead of a $14 billion company in the X-ray. And Abbott Labs, obviously the juggernaut mega cap, a huge company at $200 billion market cap. So LMAT is definitely that small cap growth company that has increasing sales numbers, but a high PE ratio. That's just the fact.
Yep.
Yeah.
Yep.
Yeah. And then Abbott, obviously the juggernaut. Most people should know that name. If not, they're a huge name in the sector. But what are we seeing the numbers there, Ty?
$111, dividend yield. 2 to 3, it's 2.5 times the other two. This one. Anyways, over double the dividend yield, 7 years of increasing dividends per year. Obviously been around a long time. Started paying dividends in 1926. Pays out half of its earnings in dividends. 35 PE ratio, 13.7% growth this year. That's interesting too. Negative next year. I wonder if they're just pulling forward earnings growth to this year or something, but assets versus liabilities ratio is good, 72.5 versus 39.5, and that was billion, correct, Greg?
Mm-hmm. Yeah, that's right. Yeah.
7.6 billion free cash flow, which is a lot, and 4 years consecutive net income increases.
All right, let's play the game, where we get to give our assessment and then Coach Greg gets to tell us why we're wrong. Generally is how it's been going lately, but that's okay. That's part of the fun in it. Let's play the game here and let's break them down one at a time. Tyler, I'm making you go first. I think I know where I'm leaning, but I want to hear your logic. Which one you buying, which one you holding, which one you dumping?
Yeah, I think the hold is, in my mind, is easy. I think Abbott's the hold for a couple of reasons. Number one, the longer I look back, the more I like this company. They haven't always been a large cap. They became a large cap over time because they executed well and had a good business. Look, I like the long-term chart. I feel like this is the most stable of the bunch. And if I'm going to hold something, I don't see any reason to sell this, I guess, right? I don't see any reason to sell this. And if I already own it, I'm holding. And I think the buy is a little more interesting on the other two. So I'm a hold on Abbott. Also has the highest dividend yield. So you're getting paid the most for holding it from a cash flow perspective. PE ratio is the lowest of the three. So, holding something that's lower on the valuation scale, I think is an easier decision to make as well. So then it comes down to LMAT or X-ray. Which one do you buy? And by default, they got to sell, the other one. That X-ray chart is quite volatile and both up and down, right? I don't mind upside volatility. It's the downside volatility that I really don't like. I just think from a technical analysis perspective, that LMAT chart I like better. I feel like it's been more consistent, hasn't had as many oopsies along the way. So I really like the chart of LMAT more than X-ray. On the fundamental front, you also have a better, and again, there's the asterisk on the PE ratio. Honestly, when I look at the fundamentals, now I'm just making something up to make it sound good. So I'll pass on that and just go with the chart. I like the LMAT chart better than X-ray. So buying LMAT, selling X-ray, holding Abbott.
Buying Abbott, or no, excuse me, holding Abbott is, I think, the most sensible call out of all of these. So I'm with you on that one. I think Abbott is a hold for many different reasons. There's a reason why the company is where they are. I liked the way that you said that, Tyler. They've had great growth over the course of the last decade. They've got, P ratio that's at 34. You elevated P ratios across many in the market right now. Forward PE ratio at 23, but they've got the history. They've got the consistency. They pay the better dividend. They have been increasing sales year over year for the better part of a decade, by the way. That's part of the reason why the company has been improving so well. And those EPS numbers have improved for the same consecutive years as well. I'm a hold on Abbott. I think that to me is the common sense call. Then it comes back to LMAT and X-ray. And this is a tougher one here. And go back to the charts, because part of this obviously is going to be in the charts, and stay on the monthly or the weekly and give me a quick look at X-ray again, if you can. I do not mind this weekly chart, although it's a volatile mess on the monthly. Back it into the weekly a little bit and see a little bit of a retracement on that weekly. Really big trend post-pandemic. It's made a huge comeback, obviously, like many companies in the market. It recently hit an all-time high and a new yearly high just about a month and a half ago. Retracement, violated all resistance. I'm not saying it's clean. Don't get me wrong. But I also look at a company that is 14 times the size of the other one. If I look at LMAT, and I'm thinking about just the nature of market cap and this one blasting off, and I got to chase it up here, I'm dumping LMAT. I'm not chasing the price action on a company that I'm not comfortable with. And I think the retracement on X-ray gives me enough interest to kind of lean there with the more, by the way, historically a stable company selling medical devices to dentists. So it's not like they've had up and downs all the time. They had a dip in 2020, and it does make sense to me. So I'm going to buy X-ray, dump LMAT, and hold Abbott. That's my choice. And Maddie, I know you had to step away, but what you probably heard maybe the end of that. What's your thought in our logic here? And do you have anything you want to add to this conversation?
I don't want to do the buy hold dump because I wasn't here for Greg's discussion on it. So I'll, but no, I've enjoyed the conversation.
Greg, what did we get right? What did we get wrong based on your opinion? I'll still hold to mine, but what do you see?
Yeah, you know what? We're closer this week than you think there, Tim. So just for different reasons. Abbott, I agree with you across the board. That thing's a juggernaut. I've owned that many times over the last decade or so. They're solid. They're not going to blow your doors off with a dividend yield, but they are very consistent. And when you start looking at fundamental and you start looking at longer term investments, things like that, consistency is a big deal. So definitely holding Abbott Laboratory. That leaves us the other two. Now I kind of held out on you guys a little bit. I don't know if it would matter to you, but it matters to me. From the LMAT perspective, I think it's overcooked, technically speaking. I'm not really fond of paying that high a price. Just from that perspective, it's run a long way. Obviously, if it pulled back to a certain spot, that would change my analysis. The thing for me is X-ray. So I dug a little bit deeper into X-Ray, into their dividends. So on our sheet here, we have dividends of dividend increases of 9 years. If we go back and look at actually the dividends, they kept their dividend the same 2007, 8, and 9, I believe. So they didn't drop it, but they kept it the same. In that respect, that means they're over 20 years of not consecutive dividend increases, because they didn't increase it, but without dropping it over a 20-year period, which I think is pretty fantastic. Then you look at it technically. I do like the pullback. I think there's an opportunity setting up here. Now, again, the dividend yield is not going to blow your doors off, but I do think that with their payout ratio only at 51%, they do have the ability to go a little bit further with that. They are a smaller company, but again, I think you made a good point in the fact that they probably got a core group of customers and things that they sell repeatedly to. So I do like that. I really like their sales numbers too. Like they got the highest growth this year. They've got a pretty good growth projection next year. So for me, I'm buying X-Ray, I'm dumping LMAT, and I'm keeping Abbott just for the consistency of it all.